And now, please enjoy Zephyr's Adjusted for Risk podcast, recorded live at Exchange.
Welcome to the Adjusted for Risk podcast. Join myself, Ryan Nauman, as I talk markets, investments, economics, and life as I help prepare you for the upcoming weekend markets. I work for Zephyr, and all opinions expressed by myself and my podcast guests are solely of their own opinions and do not reflect the opinion of Zephyr or Informa, its parent company. This podcast is for informational purposes only and should not be relied on for investment decisions. Adjusted for Risk podcast. I'm Ryan Nauman, the market strategist at Zephyr. First of all, I'd like to give a huge thanks and shout out to the Exchange team for a fantastic event and for having me, inviting me to record the podcast on site. I also like to thank them for not having the first part or this exchange, the event during the second part of the week, because I have a feeling everybody would be watching March Madness, huddled around the TV. It would be hard to get anyone's attention with March Madness, especially in Vegas going on. So thank you for multiple things, Exchange team. With that, I am very excited for my next guest. He is a wealth of knowledge in the asset management and ETF space. It's going to be a fun and engaging conversation, and I'm sure we're going to all learn a lot from it. But first, before we get started, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I am honored and excited to have Michael Mack from Victory Capital Management with me. Michael is a client portfolio manager at Victory Capital. Michael, thank you for having me. It's an honor.
Hi, Ryan. It's good to be with you.
So can you just tell us a little bit more about yourself and Victory Capital?
Yeah. So I started out at a hedge fund, long short, and in the process, everything was focused on free cash flow. We had a quantitative model. The number one factor within that was free cash flow yield. So I was able to take that knowledge and join an ETF issuer in Philadelphia. And it was interesting, in the process, got a chance to work with a lot of index providers, right? And noticed that a lot of them are quants and engineers. So they view stocks not as companies as much as data points. So, and what's interesting about that, if you look at a lot of the traditional value indexes out there, they focus on factors like price to book, where you have 150 years of data, academic research behind it, even though coming from the active side, everything is through the lens of free cash flow. So it was an interesting time to kind of see how the index process worked and really kind of focus on this factor. And then, for me as an investing guy, wanted to be at a, real investment manager, right? So Victory Capital, integrated, multi-boutique. It's a great place to be if you're if you're into investing, right? We have different franchises. You're able to see all their best ideas, and you just learn a ton at a firm like that. But was able to come over there and really kind of help work with their ETF lineup.
Fantastic, Michael. One thing through my conversations this week has been, and technology too, a lot of financial advisors, they want a one-stop shop. Technology, they don't want a bunch of different sign-ons. Is that kind of the same with asset management too, where they prefer if they could get all their products and good products from one asset manager? Do they prefer that?
Yeah, I think, on the investment management side, the number one thing is scale. I think that's something that our company's built for, right? It's to really provide, a true quality investment management services in 2025. You have to have scale, you have to have resources. I think combining different managers where they're left, there's investment autonomy, so good ideas flourish. And you can really, from our standpoint, all we worry about is investing. But at the company level, I think the other thing that is important is distribution. And really what good distribution is at the end of the day is education and its relationships, right? A lot of our strategies have to be simple, they have to be explained. And we spend a lot of time with financial advisors explaining how to use our strategies. And really, we want to be a partner. And you're able to be a partner much easier when you have that scale.
No, that makes complete sense. I was just talking to John Fee about it too. I like it. Keep it simple.
Yeah.
Keep it simple. It takes a lot for me to learn something to educate my clients. I'm not sure it's a right investment. It's like, hate to say this, but it's probably why I never got into crypto and Bitcoin, and I completely missed out, is because it took me forever to really understand it and have cash flow. How do I value this thing? And I'm late, and I never got into it.
That's right. Yeah. And at the end of the day, our clients have end clients, right? And they're ultimately the real owners of our strategies.
Yep. So you guys, ETFs, we're here at Exchange, so it's a lot about ETFs. You know, Victory Shares, your ETFs, have really had a lot of momentum recently. What's driving it? What is driving Victory Shares to where they're at today?
Yeah, I mean, I think if you step back and look at our, I'm on the Victory Solutions team, right? We help design the rules-based strategies that go into our ETF lineup, and I think we have an advantage in we're doing a couple things, right? We run multi-asset strategies, we run multi-manager, so we get exposed to a lot of different ideas. We also do a lot of active quantitative strategies. But what's interesting and I think unique about our team is we're in some places active and passive are siloed. Here, it's we value on our team the rules-based indexes just as much as we value the active quantitative. And so the thought and the attention to detail that goes into our products is the same. And I think that results in better outcomes. And so if you look at what's resonating today, it's our VFlow, our large cap free cash flow. What's unique about that is I think we're one of the first to kind of take a growth filter, right, and apply it to a value strategy to enhance value. Or small cap. We created a very liquid small cap free cash flow strategy. And within that process, there was liquidity filters, but there was also this liquidity multiplier that we came up with that allows you to kind of size your position based on liquidity. Okay. So we're trying to get in front of things and issues that occur in the marketplace. We want to be proactive in solving client solutions or client challenges. So we're going to anticipate those and try to provide a solution. And then maybe the last one I think we've seen a lot of success on the rules-based side has been this value momentum. It's a case where an allocator found us and reached out. What they liked is the problem is a lot of people want to have value. They want to have momentum. If you own funds separately, what can happen is they offset each other, right? And so you can buy a value and momentum ETF and end up with no value and momentum exposure, right? So what this does is it applies value and momentum at the individual strategy level, which means that owning a strategy like this will result in the intended factor exposure. Mm-hmm. And so it's nice to see a well-constructed product get rewarded in the marketplace in a world where so many people are just surrendering to the passive indices.
Right. And, I've heard a lot this week about active. And for me, I think passive is great, but with the market's uncertainty, there's only one certain thing in markets, and it's uncertainty. Markets hate uncertainty. We've got a lot of that now. So active ETFs really are a big part of in a good solution, I would think, for this market environment.
Absolutely. Yeah, we're big believers in active ETFs, and I think people really do want it. They just want quality when it comes to their active ETFs.
That's a very good point. And you mentioned factors. You have a really exciting session tomorrow. I think it's titled Factors 2.0, the smarter way to index. I'm really excited for it. It should be a great session. Can you give us a little teaser about it, maybe?
Yeah, it kind of touches on what I mentioned in my background, kind of how we're going about it. But it's really this evolving of a lot of these indexes that were initially designed, they were designed as benchmarks, right? And so when you think of the first iteration of factors or even the style, right, you have like your traditional value ETF, right? It'll take one of the traditional benchmarks. Well, those weren't necessarily designed to optimize performance. They were designed to provide a broad measurement of performance for a particular style. I think the Factor 2.0 evolution is really, how do we make this a really top-notch investment product? And I think the line between active and passive is blurring, where there's a lot of active thought that goes into constructing these rules-based indexes. And I think that's what we're going to focus a lot on, because I think that, at least for our team and the solutions, I think we see that as one of our competitive advantages in the marketplace.
I completely agree. And one factor that you talked about too, you mentioned momentum, you mentioned the quality factor. Let's focus on quality. I feel as if quality sometimes kind of takes a backseat to momentum. Momentum always seems to grab the headlines. It's a little bit sexier, but that quality factor, you need it. Can you maybe talk about why quality still matters?
Yeah, I think it's interesting to see. I think what the client is looking for at the end of the day, I think when they think of quality, I don't think they think of like a quality factor per se. Okay. I think they view quality as, I want high quality stocks that I can own for the long term. I don't want junk companies, I want quality. And I think what they're intending, what they want, the result, is a more defensive portfolio. It's something that's going to do well over time. And I think what's interesting is we're seeing a lot of interest for people that were in the quality factor, right? That's worked, and what they're saying is, hey, we want to proactively maybe balance that out. Because what's happened is, we've seen this across the market, there's been a drift, right? Everything is shifting towards the mega cap growth names, right? We have a game where we're like, oh, do you know what's in your index? And the amount of times you see Microsoft, Alphabet, Apple we've seen it in a dividend value portfolio. But with going back to the quality, they're using free cash flow as a quality, right? Not susceptible to manipulation, true cash. And they're saying, I'm going to get quality exposure through free cash flow, which on top of that, I get value, right? Because we're using free cash flow yield. So if I combine a strategy like VFlow with a quality factor ETF, right? Now I've balanced and I'm no longer growth dependent, and I've kind of solved that valuation challenge in the market.
So why free cash flow? Let's focus on that. To me, and we talked about this earlier, free cash flow, it seems like it's really come on to the marketplace here within the past couple of years. You hear more and more about it versus, like you said before, it was all about leverage and debt ratios. Why is free cash flow important?
Yeah, I think there's just a disconnect between the active and passive. And we've talked about earlier, a lot of the active people don't really want to embrace the passive side. So I think if you looked at where the passive side's focused on, it is that price to book, where you have a lot of data. You have the FAMA French studies. But I think from an active lens, right, whether you're a private equity firm, it's all about free cash flow, where you run a discounted cash flow model. So in the active world, it's taken as given. It's really only unique to the factor side. And I think what is unique about it from a factor is kind of how it applies value. One, it's relevant in today's economy. I think if you read an article, right, 17 years of growth beating value, right, what makes you think year 18 is different? And within those articles, you always get the question of, do accounting measures still matter in 2025? And our view is they absolutely do, but there are challenges for some of these modern asset-light companies, right? And one of the challenges, R&D. The way the earnings, right? You take a metric like earnings, R&D is deducted 100% out of the bottom line. So R&D heavy sectors like technology and healthcare, right? Their bottom lines are hit for that investment. Now you take a traditional old economy sector, energy, materials, industrials, a lot of their investments are classified as CapEx, which the way earnings treats it is you only write off or depreciate, say, 20% of that. So what it does is that earnings, a metric like earnings, will skew against technology and healthcare, or price to book, right? Asset-light companies also don't screen well. So if you're using those traditional metrics, you're going to end up tied to the old economy. You're not going to get enough technology and healthcare. Well, free cash flow solves for that by leveling the playing field. So it will find value in places like technology and healthcare because it just treats R&D and CapEx the same. It's a cash expense. So when you level the playing field, you get better results. And then from a return stream, what's interesting about free cash flow is it does well in a value environment, right? It's a value factor. But then you think about a growth market. A lot of traditional value measures, right? The performance gives it back in a growth market. Free cash flow has been able to hold up typically in growth environments. And that's made it a very useful tool for investors' portfolios.
That's interesting because, like you said, before when you invest in value, you are really ignoring a lot of growth, your name, the tech and companies that have a lot of free cash flow. So that's really interesting in terms of a portfolio construction viewpoint. What are some sectors maybe where you guys think you can find value with free cash flow?
Yeah. What's interesting about the sector exposure in regards to free cash flow is it evolves over time. So it's not static. If you look back the last 20 years, you would have seen a lot of technology exposure. You see less of that today because we're measuring free cash flow yield. So we're taking a profitability metric, turning it into a value metric by putting it over enterprise value. Well, if you think of technology companies, they're incredibly profitable from a free cash flow perspective, but their free cash flow yields have declined as the price has gone up because the price has increased more than the free cash flow. And so you still have a healthy technology exposure in free cash flow strategies, but maybe less in the past. And then on the other end, you had a sector like energy where free cash flow would have avoided a lot of those names from about 2006 to 2021. Because if you think of historically an energy company, they spend a lot on CapEx, right? They had poor cash flows, they had a lot of debt. It was growth at any cost, kind of the old wildcatter mentality. Well, today it's profitability at any price, right? COVID, prices going to zero caused them to change the way they operate. Today, management is compensated on free cash flow. Their balance sheets are stronger. The reason they're generating so much free cash flow is they become more productive. So if you think of, a couple companies in the Permian recently came out and said, it used to cost them $70 to produce a barrel of oil. Today, they're able to produce it in the 30s. So that is why they're generating such free cash flow. And so it's not about the oil price that gets a lot of attention. It's really about the cost and how productive they've become. And so it's an example of how free cash flow can evolve to identify value over time across sectors.
You mentioned VFlow, your cash flow ETF, free cash flow ETF. What's driving it? You guys hit some milestones recently, correct?
Yeah.
Congratulations, Victory Team. What's driving that strength in the demand?
Yeah, well, there's a couple unique things where, in terms of we're focusing on free cash flow, but again, part of our team is, the advantage of our team running active quantitative strategies. When I joined, we started looking at this free cash flow concept and said, how do we improve it, right? And how do we build upon it? And, one of the ideas was, two things really came out of it. Number one, we measure free cash flow, not just on a trailing basis, but also on a forward-looking basis. And that has two benefits. Number one, you avoid companies that were profitable, that there's an obvious trend in the market where they're no longer going to be profitable. So you think of energy in 2014 as an example. Oil goes from 100 to 40, right? At $40 oil, these companies aren't going to generate the same free cash flow they did at 100. The forward-looking measure will solve for that. Or during COVID, a movie theater company, right? 2019 generated a lot of free cash flow. Even an analyst, right, can figure out that in COVID, no one's allowed to go to the movie theaters. AMC is not going to make a lot of money in that environment.
Yeah, exactly. The 9 style box, equity style box, it is still relevant today. A lot of people use it. To be honest with you, I think we could get rid of it by now. I think that was totally 1980s, 90s. But let's talk about it. When you look at cash flow and let's say VFlow, how do you incorporate it into a portfolio? We talk, typically you think, well, it's a value play, but you just talked about earlier, now you're incorporating a lot of growth names into it. Do you take it more of a core position?
Yeah. Well, it's interesting. So we talked about earlier, VFlow will take a forward-looking perspective. The second thing we do is apply a growth filter. Okay. And what's interesting about a growth filter is you think, okay, that must come at the expense of valuations. But what's interesting is you can actually find, if you take all the high free cash flow yielders, sort them based on their growth rate, there's not much of a valuation difference. So I can identify faster growing companies at the same valuation. So in that case, I've added growth without giving up value. So this will still fall squarely in the value box, right? But having that growth filter gives you a better quality company, right? And you're not, if we get a growth market, you're not in some of those, there's traditional names like, a telecom company, right, that hasn't grown in 20 years. That might trade at the same free cash flow as a tech company that is growing a lot. So that growth filter enhances the process. It makes it more resilient. But at the end of the day, right, what we're saying is lower your PE before the market does it for you, right? I mean, the S&P at these valuations levels, it's never ended well. This is a tool to meaningfully lower your valuation, right? And where that can come into play is there's been some great research talking about there's two types of bear markets. There's the systemic shock, 2020 and 08. In that case, correlations go to 1, right? Strategies like this, we're going to go down 1 to 1, right? Now, on the other hand, there are these valuation-driven bear markets, the early 2000s, 2022. in those environments, right, having a low PE, high free cash flow strategy can actually be very defensive. And so we think in those environments, you have a chance to take one of the ways to lose money over time in the market off the table by just controlling the valuation. And that's the number one thing that's resonating.
Fantastic. Sounds like a great opportunity. And, at Zephyr, we really focus on investment analytics. And one of them is, risk return statistics and upside downside capture. So I'm assuming a product like this, you talk about, it benefits when environments are for value, kind of the value stage, but also you can capitalize some when the environment is opportunistic for growth.
Yeah.
So I'm assuming you kind of got a good balance there when the upside capture, downside capture investment there.
No, that's absolutely the case. Yeah.
So Michael, I started off talking about March Madness. How's your bracket?
Oh man, yeah, not good. Yeah.
Well, at least, I probably shouldn't talk about it. As a big Wisconsin Badger fan, I tossed my bracket. I doubled down on the Badgers winning it all. And so I tore up my bracket. It's done. So I don't even really want to talk about it much anymore. But at least the Badgers made the tournament. Where's Villanova now?
Oh, yeah, we don't want to talk about that. We're looking for a coach. So, if you find a good one, or, hey, Jay, if you want to come back, please.
Yeah. He does a good job on camera, though.
He does, I know. But, he would be better as the Villanova coach.
Yeah, I agree. Michael, it was an honor, really fun conversation. You brought a ton of great knowledge. Where can our audience get more information about Victory Capital Management?
Yeah, if you go to vcm.com, you can get additional information as well as a link to the prospectus.
Oh, those prospectus.
That's right.
Yes,
there you go, compliance.
Yes, you hit the compliance requirement.
Yeah.
Yes. Awesome. Thank you, Michael.
Yeah, thank you,
Great
Ryan.
conversation. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Please feel free to subscribe to the YouTube channel and follow us on LinkedIn. Thank you, and have a great rest of your week.
Let's get started.